A warm welcome to everybody out there. Today at 28th of September 2017, my name Stefan Friedrichowski, as always, for those types of webinars and at that specific date within the week. It's a pleasure for me to have you here and to the next webinar with the title, The 5 Biggest Mistakes in Discretionary Trading. Okay, that's really a little bit different kind of webinar we do today, but you will see it's a mixture. It's not a trading strategy I will introduce once again here. It's more learning from other people's mistakes. And other means, for example, me and my own observations. But still, even talking today about discretionary trading, it means that we will have some aspects of statistics as well. More or less every mistake I will underline and let's say prove by some specific Excel sheet. And as always, if you have interest in those Excel sheets, just send me an email to s.friedrichowski@jftbrokers.com, and I will make sure that you get all the sheets. The slides of today you can already download via the GoToWebinar control panel, as always. And that's it. That was I want to mention. Sometimes I got questions simply, how can I view those videos later once again? So yes, there are always recordings and you can find them on the JFD YouTube channel, and to reach that one is quite easy. Go to Google and press JFD YouTube channel, and you will automatically be directed to that YouTube channel. There you find my webinars, but also those of my colleagues. And even now, there are already some webinars in French, if you like. So that's a good trader as well there, and he is doing French webinars. But anyhow, let's go into the topic of today. As always, I have to show this slide once because we talk about trading strategies. Therefore, here's a risk disclaimer, meaning whatever you will learn here, finally, if you trade, you simply trade on your own. And I think that's self-explaining, and you know what you're doing. Nevertheless, I hope you can enjoy a few aspects of mine here as well, and to get some other insights. Let's see. So it's not the normal introduction I use here, because I do not list just the 5 mistakes and that's it, because that would be too simple, and just to name them without knowing why is not the right way. And I will show you why. But nevertheless, let me explain you how I come to those 5 mistakes. And by the way, it will be 6. I have 6 topics, but anyhow. So it's my personal experience of trading for more than a decade right now. And I want to mention that a lot of experience I got from other people trading simply by offering coaching for them. And therefore, I learned a little bit more about those other people. Of course, I will never name somebody personally, but the one or the other might even know what I'm talking about here, and who has been in that coaching. But anyhow, we will have some general thoughts about or concerning trading as well, because that is already sufficient to come to some conclusions. So, but let's go on. So the first one I want to mention here is what I call overtrading. What do I mean? I know, especially from my own experience and from other people using that coaching, that many traders tend to have a too high trading frequency. So they are simply trading too many trades a day. So especially if you have the time, the complete day or whatever time frame you might use. So in total, you might do 5 trades, 10 trades, 20 trades. Basically, the number is not, I would say, that important. You might trade 1 trade per week, or you might trade 20 trades per day. That does not automatically mean that you are good or bad or profitable or not profitable. But what we have to keep in mind is the relationship between the trading volume we trade and our account size. And I will show it to you with some numbers. And I hope that this is already the first eye-opener for you, because simply by trading itself, we generate costs. You know my sentence. If I open a trade, I'm instantly in minus. Why? I have to pay the spread and I have to pay commission. And even if you would trade at a market maker where you don't have commissions, but then you will see you will have higher spreads. So anyhow, there are costs of trading, and instantly opening a trade means you are in the minus. If we have a high trading volume, that automatically generates quite a lot of costs. And now change your perspective. Think more like a businessman owning a small company. And of course, the first thing you have in mind is if you have costs, you have to cover your costs. So that is the first what you want to achieve. But let's go into an Excel sheet because then it becomes maybe a little bit more obvious what I'm talking about. And that Excel sheet does not really do a lot of things, but they will illustrate the costs of trading. Let's assume we have an account of 500 euro. So really a small account, but anyhow, it's enough to have trading activities. That's just an example, but you can scale it up and down as you like, so no problem. And now I took 2 numbers, one for spreads. I assume 0.4 bips, which is already at the lower end. Euro, US dollar, you definitely can trade for 0.4, but other pairs like for example, British pound against New Zealand dollar or something like that, or maybe British pound against Australian dollar, you might have even spreads with 1 bip and even higher. So, but 0.4 bips typically can be translated to 4 euro if you trade 1 lot. So those 2 numbers here are simply per lot. So now let's add the commission. So we have a JFD 5.5 euro per lot, and that adds up to nearly 10 euro if we trade 1 lot. Okay, so that are the costs per lot. And now let's assume that you have a trading activity, daily traded volume of 0.05 lots, which is not much. It might be 5 trades with 0.01 or maybe 1 trade with 0.05, anyhow. So let's assume that is your daily volume being traded. That would generate daily costs of nearly half a euro. And if I multiply that one with 250, which is about the number of days you can trade if I neglect the Sunday late evening hours, then this adds up to 120 euros. And now let's compare those 120 euros with our account size of 500 euro. So it's about 24%. That means we need a profitability in terms of rate of interest or return on invest, and we will talk about that number later as well. But let's take that number. So we need a profitability of 24% just to cover our costs. which is quite a lot. So, and even if you think about that, um, that this is not that much. Of course, you can earn those costs by your trading activities, but let's go a little bit further. Let's assume, and that's my experience with other people, that they, even in that small account, they trade per day 0.2 lots. Okay, now we have already a need for 100% profitability just to cover our costs. That's still not earning any euro. It's only covering costs. So what is the message here? Look to your account and look to your costs of trading, and might be that you think about, hey, do I trade too much? Do I have too many trades per day, or is even my lot size simply too high for my account? We talk about stop loss later, and risk-reward ratios of trading. That this has to be taken into account here as well. And it's not my message to say generally, hey, you can't trade 0.2 lots with a 500 euro account. Of course you can. But still think there's only a limited profit you can take out of the market. And if you would need 0.2 lots per day with that kind of account, it will be hard to cover your costs. So that's the message here. That's overtrading, or I call it simply overtrading, meaning you trade too much. And maybe it's better to check it and have a look to your account. It's quite easy. Just go to your MT4 statement and add up your commissions, and you know how many trades you have entered. Then you can build a number for the paid spread as well. And then you know your costs of trading. And it might be good to have a closer look to that. Okay, so that's one thing, and that's a typical mistakes many people are doing, especially those who are beginners. They think, okay, with the next trade, everything can be covered, and the next one, and the next one, and the next one. And that's definitely not the right way. So avoid over trading. But let's jump into the next topic. And that is the one I simply named risk management. And what I mean here is not what most of the people are talking about, and you find in books, textbooks about trading. There is always a long debate about a 0.5% per trade, 1%, 2%, 5%, whatever number. No, that's not exactly what I have in mind here. It's more to follow exactly that number of risk per trade. So it's extremely important that you have a given number as risk per trade for your next trade. If that is 0.5% of your account, okay. If it's 2% of your account, okay. That's not my message. My message is calculate that number. Maybe you have different numbers for different kind of trading activities. For intraday trading, you go for 0.5 or even 0.25, and you have daily activities, you might risk 2% of your account. Write those numbers down and then follow exactly that number. But before really going into that detail, of course, I have to mention trading without a stop loss, because that is the next one we have to have in mind. That is a stop loss, and that comes with a risk for your next trade as well. So if you don't want to have unlimited risk, then it's a no-go. Saying unlimited risk is not true for every kind of trade. And therefore, I have already in brackets here exception, ... Simple reason. So if you may buy one lot DAX long trade today, then the DAX is right now about at 12,000 points, then your risk is limited. if you buy one lot, your risk is limited to 12,000 euros. So if you are willing to accept in principle a loss, it's not highly probably that the DAX will be tomorrow at zero. And honestly, if the DAX would be tomorrow at zero, I think we have other problems than thinking about our trading activities. But anyhow, your risk is limited for a long trade on DAX. For a short trade, not. But that's more mathematically speaking. So if you're willing to accept the loss of 12,000 euros, you can, of course, buy one lot DAX without a stop loss. And there might be other exceptions that you don't set a stop loss. Maybe you have an expert advisor constantly looking to your trades, and if so you have a virtual stop loss, because then the expert advisor might interact with the broker. So that might be other reasons that you don't have an explicit stop loss, but you have at least a stop loss in mind. So what I do, and that's already my solution approach here, is simply that a trade needs a given risk in euro and a stop loss value. And out of those two first numbers, the given risk and the stop loss value, like a long trade DAX 12,000 points, entry level stop loss at 11,000 points, whatever, then we can calculate the resulting lot size for our trade, having in mind that if we do it in exactly that sequence, we have a given risk in euro. Still, there might be gaps. There's a risk of gaps. So let's put them aside for a moment. But finally, we have a given risk per trade. I don't do it normally vice versa, because we could do it vice versa as well. If we have a given risk, we can set a lot size for our trade, and then it would result in a stop loss value for our underlying. But that's not my favorite. My favorite is other way around. And let's be a little bit more practical here. Let's get a chart in order to really see what I do here. And then I can introduce a small Excel sheet, which helps me if I do trades like discretionary trades here out of the chart. Let's assume in this case we have the US dollar, Japanese yen. Let me have a quick check of where we are. Daily chart here. Okay, there's really no good trend. And we might be at another upper limit here. So south direction may be in favor. And let me quickly jump through some different timelines and go back to my M14 chart. And now I say, okay, I come to the conclusion. I go with a short trade here. By the way, that would be another mistake. What have I done here? I used 2 minutes or maybe even less in order to come to an opinion. Now I would want to enter a trade, and I have in mind to maybe profit later 100 euro or whatever number. Think about it. Think like a businessman. Do you think that with an investment of 2 minutes, you can automatically earn, let's say, 100 euro? Question mark. So be careful. I do it here just for illustrating purposes, but have in mind, I don't come to a trading conclusion within those 2 minutes. And looking more and more about this chart, I change my mind. I go for a long trade. So now let's think we would go market here, and for simplicity reason, I first, and I will later show you another way how to come to a stop loss level. I say, okay, my stop loss level might be here. And what I do now is I write down those two numbers, 112.421 would, let's say I go market into the trade, and I have 111.978 being the stop loss value here. So what I need else in a second is the exchange rate between euro and Japanese yen, and I will show you why. But now I want to calculate my lot size. And for that purpose, I have created a simple Excel sheet here, and that Excel sheet works the following. What we need first is that we need the contract size. For Forex, it's always easy. It's a 100,000. I wrote down already other numbers here for other underlyings like DAX, S&P 500, gold, and oil. Then you have other numbers being the contract size. Forex is a 100,000. That's all. The next thing, we want to trade US dollar. I write it down here, US dollar, Japanese yen. And my speaking about Forex pairs is always like there's a first name and a last name. So first name US dollar, last name Japanese yen. If we trade this one here, what we need is Euro XXX. That means we need the exchange rate Euro Japanese yen. And that was a reason to get that number of 132. And now my entry was 112.421, and the other one is the stop loss value is 111.978. And now I have to say how much money I want to risk with the trade. And let's think that I want to risk here 20 euros. Then I can trade 0.06 lots. Now it's a little bit funny that because that number here must be something like 5999 or something like that, because my cut number here is one digit less. So in reality, I would, let me just cross-check this one here. If I go a little bit higher, then yeah, we come to the 0.06 lots. But anyhow, so what I now have, I know exactly that I can trade 0.05 lot and my risk will be a little bit less than 20 euros. And I can have a stop loss value as being set and at that entry level. And I do this always. No trade without that kind of calculation. I want to make sure that with my given stop loss value out of the chart, in this case, let me go, switch back here to that green line here, that I do not risk more than 20 euros for that next trade. Therefore, from that stop loss value, I calculate the lot size, and now I'm on the safe side. And don't do it, or that's at least my recommendation, to say, oh yeah, my next trade will be 0.1 lot. I know that I have done this always. You can do that. If you would have a fixed distance for your stop loss value, then you might do that kind of calculation once, and then you can enter your trades that way. But it's not my favorite, because I want to adjust my stop loss either to the chart itself, like looking for resistance lines or something like that, or, and that is the next topic, some other helpful tools to come to a stop loss value. But let's see. So the risk calculation is essential. Not doing this, I think, is one of the biggest mistakes people can do with in their trading activities. So no placement of any trade without a stop loss and a given risk in euro. So, or whatever current account currency you have. But it's important to do it. Not doing, and I saw so many examples, just entering trades, not knowing the risk of that specific trades. It's a disaster. We have other possibilities to create the stop loss value, like just out of the chart, but that is now one of the next topics. And that is the stop loss setting in general. So we know already that a stop loss is quite important for any trade. So stop loss is a must, and it comes directly to the next mistake a lot of people are doing. Quite often, stop loss values are extremely tight, meaning, going back to my chart and my picture here, that people just look here and say, okay, no, stop loss for that trade might be here. A little bit below, for example, to the previous candle. So an extremely tight stop loss, then seeing, okay, that looks great. Going long here and target maybe here. And finally, what you have here is a risk-reward ratio. Visually, it might be above 10, so it looks great. And that will be the next topic on the next slide. But before we come to that, so one thing a lot of people are doing is that they use extremely tight stop loss values in order to create a better risk-reward ratio. But that's not good. You will see in a minute. The logic people are following here is often a little bit like I did it in my 1 minute derivation of my trade. We look first maybe on a daily chart, then for several hours, and we might even have a clear picture of what time frame for that trade is appropriate. So what I have always in mind is to look how long should that trade run. And in this case, I say, okay, several hours. That's my target for the trade duration. But then finally, people are looking for the stop loss value out of the chart, maybe even in an M1 chart. And that is not good. Simple reason, we know that our markets, they have what I call a natural noise. And that noise has to be taken into account. So prices are always a little bit wiggling around, and going back here to my chart, it would mean, okay, if I now would have entered my long trade, just a little bit moving around, that stop loss would be hit. And it's simply gambling to say, if that stop loss value is not hit, I can reach that target, but that is not trading, that is gambling. And therefore, I simply won't go for something like that. The good thing is we can help ourselves. Two possibilities. One is, and that is something we have looked already in previous webinars to that kind of curves or that kind of analysis. What I have calculated for the last 14 years is the average move of an underlying in whatever direction, long or short, after a specific time. So how to read that chart? Let's simply go here for Australian dollar, Japanese yen. What can we see here? So after 50 hours, which is about 2 days, typically in average, and that means in average, the price would be 1.5% away from my starting point. 1.5%. And what you see here is you see that more or less square root behavior, which is really close to square root, what we see here. By the way, this is a hint for random walk behavior of our markets. And finally, you know my comments on that. What we need is the deviation from the random behavior in order to enter profitable trades. But anyhow, so we know if we have 50 hours as a target for our trade, for the trade duration, we can expect movements of 1.5%. Would it make sense to have a stop loss value around 0.2% for that trade? Answer, no. Definitely not, because typically we would be kicked out of our trade already in the first 2 hours. Because we can follow that line here down, and then we have an indication, hey, that does not work. So you might, in order to have good stop loss values for your trades, of course, you have a trading idea behind, maybe a trading logic or whatever, that will help you to set your stop loss value as well. But if you don't know exactly how to set it, those lines might help you. And what you see here is Australian dollar, Japanese yen is moving more far away within a certain time than currency pairs like, for example, Euro, Swiss franc, or Euro, British pound, which are at the lower end of those curves here. So that is one thing. So you look for an expected trade duration, and for example, if you go for a trade which should run for 1 week, which is about 120 hours, you can expect Australian dollar, Japanese yen, a movement of 2.3%. But once again, then you can't set your stop loss value like here. That's not a good idea. So that's one thing, what you can do. The other thing you can do here to get a good stop loss values, or to at least to have a hint of where to set the stop loss value, is you simply use an ATR in your chart. And what I always do is I use a fixed minimum of 0, because that gives me more meaningful charts here. And normally I use periods which are a little bit higher than the standard values. For example, for H1, my minimum would always be 24. So I have always 1 day history for building up the number. And even for an M15 chart, still in this case, I would use the 1 day. So then it would be a period of 96. So let's have a look here. And what I see, okay, my ATR value right now, and you see immediately why I use that 0 as a lower limit for the chart, because otherwise it looks always crazy if you have it zoomed up here. So we see we have about 0.1 being the ATR value. 0.1, that would be from the green line we have here, it would be something like about here. So that's one ATR distance, and a good first estimate is always to have something like a factor of 2 or a factor of 3 ATR values in order to have a good stop loss value. Another possibility to have it more graphically directly here is to use a Bollinger Band, and not just to create that trade. No, it would be in order to get a stop loss value. I use the same period 96 deviation is something like here, and then you see what would be the distance for a stop loss here. So right now, okay, you see we are already out of the Bollinger Band, but I use visually that distance between the middle line and the lower limit here. That kind of distance would be a good hint for a stop loss. That means it would be something around here. And then you have already 2 good hints for getting a stop loss value for your trade. either ATR or Bollinger Band. Both have simply the reason to avoid to be kicked out just by market noise. And that's what we want to achieve here. So stop loss setting is quite critical, and we need it. And we have two easy tools. And even if you look to that chart here, the typical move within a certain time, those help you to get your stop loss setting right. But as I mentioned, risk reward ratio for your trading is another good thing. And I name it a little bit different here. Just the tail of risk reward ratio, or the tail of good risk reward ratios. The internet and the websites, you find hundreds of statements like, hey, here we have a trade with a fantastic risk reward ratio of 10, or a fantastic risk reward ratio of 5, something like that. So people are telling you that the risk reward ratio of that trade is high, and because the risk reward ratio is high, it's a good trade. But that's nonsense. That's bullshit. So the thinking behind is the higher the risk reward ratio, the better. But that's bullshit. There's no logic behind that statement. A little bit more correct would be the higher the risk reward ratio, the smaller is the necessary hit rate in order to be profitable. That is correct. You know, if you have a risk reward ratio of 1, then neglecting the cost of trading, you need a hit rate of 50% in order to be at break even. And risk reward ratio of 2 to 1 means you need 33.3% hit rate, and so on and so forth. But still, that does not mean that the higher the risk reward ratio, the better. Nonsense. If you would think like that, you should play lottery. So in Germany, you can buy a typical a Saturday ticket. I think it costs around 10 euros. I'm not familiar with that, but let me take just those numbers. It costs you 10 euros, and it's the name is 6 out of 49 plus 1 or something like that. And in principle, if everything goes with you, then you can earn 1 million or even more. So invest 10 euros, potential gain, potential profit, 1 million. That would be a risk reward ratio of 1 to 100,000. Crazy. Is that good? Nonsense. It's only a high risk reward ratio. And the probability to be on the winning side is quite low. Remember that number, I think it's 1 to 149 million. That's a probability to get the jackpot of that lottery. So high risk reward ratios have nothing to do with good trading directly. The mistake behind is always that thinking in risk reward ratios is like I can adjust my potential profit. In principle, that is correct, because that gives my target value for the take profit. But we still know we have hit rates. And the higher the risk reward ratio, typically with all trading activities, the hit rate will be come quite low. So that's one thing. The other is that, and that might be new for you as well, the higher the risk reward ratios in your normal trading activities are, then the typical drawdown of your trading is even higher. Let's look to that a little bit more practically. And that we do with an Excel sheet here as well. And honestly, even that Excel sheet is one Excel sheet we used already in a previous webinar. So let me guide you quickly through that Excel sheet. It works with random traits, so with random numbers. And in this Excel sheet, we can really adjust everything. That means we can enter a number for our hit rate of trading. And in my case here, I have a hit rate of 50%, and my average gain is 1, and my average loss is -1, and my risk per trade is 10 euros. So it means I always either I gain 10 euros or I lose 10 euros. And automatically the expectation value per trade is simply 0. And in this case, we do 1,000 trades, and my expected value for my trading account after 1,000 trades is simply still 1,000 euro, because all the numbers are adjusted like that. But now the but, or the astonishing result. Let's look to the maximum drawdown during that trading sequence here, 1,000 trades. The maximum drawdown is, in this case, 310 euros. Okay, let me just resample everything. So it's now a different trading sequence, still same statistics behind, but we get a number of maximum drawdown of 570 euro. And so on and so forth. You see, whenever I press F9, we get new numbers here. Sometimes our account is slightly positive after 1,000 trades, sometimes slightly negative, or this one was not that bad. And you see, our typical maximum drawdown is 200, 300 euros, sometimes a little bit higher. Okay, so even that can happen. And now I come to an extreme value directly. Let's assume we have a hit rate only of 10%, and we have, but on the other hand, we have a risk-reward ratio of 9:1. So still, just following simple math here, that calculates to our expected value is still 0. So for that hit rate of 10% with a risk-reward ratio of 9:1, we can expect no gain, no loss. But you see already in the first sequence here, our maximum drawdown is already 1,000 euro. Let me press F9 once again. 840, 720, 900, 1,000. Oh, in this case, the account would be ruined. But anyhow, you see what happens? The higher the risk-reward ratio you trade, the higher the expected drawdown will be. And now it comes to the psychological aspect of trading. Drawdowns are nothing you want to have in your account, and those phases, time periods, might make you crazy during trading. And now you see what happens with those high risk-reward ratio. Pure statistical argumentation lead to high maximum drawdowns automatically. And the story is still valid even if I make that account profitable already here mathematically. Like I add a little bit hit rate here, so you now see my expectation per trade is now 1 euro, and I should have a 1,000 euro gain. After 1,000 trades, but still we get high numbers of maximum drawdown. So you see what happens. So message: trading with high risk reward ratios is not instantly something which is good. And even worse, trading with high risk reward ratios and normal hit rates according to those risk reward ratios, and you will suffer higher maximum drawdowns. So that is something we have to keep in mind, because it's not something you might have on your agenda always. Okay, so that's about risk-reward ratios. The solution is simply, there is no good or bad risk-reward ratio. No, there's only, you need your statistics on your trading account, and then you know what's going on. Okay, just one remark on that. If you want to have a trend following approach, then typically, yes, you need risk reward ratios in the range of about 3 or something like that, or you need higher risk reward ratios. Reason? Trends, and that is for a trend following approach, trends are more exceptional than usual in all of our underlyings. So relation is about 30 to 70. So already that is telling you you need higher risk reward ratios because you will not survive. You need those sequences of losses to get from time to time those extraordinary profits. So that is more out of all my activities, trading of building up trading systems, then you learn automatically you need higher risk reward ratios in order to survive. Anyhow, so it's really a tale of the good risk reward ratio, and I hope that you have learned that the higher your risk reward ratio, then normally the higher is your maximum drawdown. Next thing I want to mention here is never to forget the costs. And especially if you trade on higher time frames, like daily time frames, then we have to consider the swap costs. We talk about at the beginning of this webinar already about costs, but now we look for the swap costs, the financing costs you have within your trading activities. So normally, if you do just intraday trading, okay, then that is not a topic for you because you will never have swap costs or swap gains in your account. But a lot of people are doing trades maybe a couple of days or a couple of even of weeks, even months, and then that is a quite important topic, looking to the swap costs. Generally speaking, long trades on indices, they generate always swap costs. And if we would have, once again, higher interest rates, then we will finally reach the state that if you enter a short trade on an index, then you will even gain swap costs, so you will earn money by entering the trade. But right now, we are not at that level. For Forex trading, the story is a little bit more complicated because then it involves the different regions we trade against each other, like euro, US dollar. It means it's a European area against the US area. Australian dollar, Japanese yen. So once again, two different regions. And it depends on the relationship of the interest rates in those regions. And they have an impact on the final interest rate or the swap costs of your trade, short and long. So why are those swap costs that important? Let's have a look to an account of mine here. And that is, I have one account which is really trading long term. So it enters the trades on a daily base, and maximum duration of a trade here is 120 days, and that's calendar days, so 4 months. So it's a quite long time. And what I want to share with you here is just a list of trades. So we go to the history of that account, and by the way, the account is really maybe that one first. You see, it does not look that bad. So it started in April. Balance is right now 122,000 euros. Equity is even nearly 150,000 euro for and that for 4 months or 5 months is really not that bad. And now we go to the list of trades of the history, and let me simply adjust the list here in the order of swap costs. And now, oh, and there's vice versa, just a second. So now, here we go. And now we look to the list of trades being done here. And you see, I have trades, okay, they have a trade duration of 5 months, 3 to 5 months. And you see what number we have. Swap costs of 100 euros. Okay, the profit here was nearly 300. That's good. In this case, so finally that adds still up to a profitable trade. But just look to the numbers you can have here. It was a long trade, euro, Australian dollar, and that is a number you have to gain first in order to be profitable. So it's normal that you have those swap costs. It's nothing you can blame the broker for, because the broker is only transferring the costs. The broker itself has to pay that cost to the liquidity provider, where finally your trade really is in your trading activities. But so it's real costs, and they have to be covered. And you see that there are trades here, minus trades, 200 euros, and additionally on top of that, we have 70 euros trading costs via swaps. And okay, the trade duration was about 4 months. And you see the lot size is 0.11, so it's not that huge. There are big numbers for swap costs, and those have to be taken into account if you enter trades on a more long term. And message here is quite simple. Just look to the web page. For example, here the JFD broker web page with all the swap costs, and where we are here. And then you can have always a quick look of what's generating money and what really generating costs. And then you can have that in mind. And maybe the idea is quite simple. Avoid trades with high swap costs. The good news is the Forex universe is that huge that you will find always other and finally better trading possibilities, trading chances, and then simply avoid those with high negative swaps. And then you are on the more safe side, and you don't have costs like in my account. In that account, it's okay, because the trading strategy behind has already been built with those swap costs. And so that kind of strategy, let's call it, the strategy knows what it is doing. But just looking for a long-term trade out of the chart, then I would say I avoid those Forex pairs which have high negative swaps, and I will find other possibilities in that Forex universe. So it's not a real limitation for your trading activity. So that's about swap costs. Finally, one topic here, and this is a question I get a lot of questions. Questions about that as well, via email or coaching or whatever. And that is the expectation values all around trading activities. So what profits can I expect with my personal trading? That's a fantastic question. And by the way, my first answer when I get that question is always, how much money are you willing to lose? And then people are a little bit surprised because of that question, because they talk about profits, and I talk first thing about what are you willing or accepting maybe to lose. It's quite funny, but anyhow. So reason for the question is that people think trading gives quick and fast wealth. Yeah, but that's not right. So first thing which is wrong on that discussion is already thinking in percent rate of returns. So we love those percent values like, hey, my account has increased by 23% within the last 3 months, or I have doubled my account in 1 month. Numbers like that you find in the webs, the internet, all around. But let's come to the basics. Just an example here. Trader A has a gain of plus 20% within 1 year, and he has suffered a drawdown during that year of 50%. And we have a trader B with a gain of plus 10%, and that one, the maximum drawdown within that year has been 5%. So which one is now the better trader? Or what is a better account? What is the one you may like to follow, or whatever you want to do with that information? Of course, it's trader B. I think it's quite obvious. Of course, trader A has more profit, 20% instead of plus 10 with trader B, but with a drawdown of 50% instead of just 5 for trader B. So thinking purely in percent rate of return or interest rates, like something like that, or just another number for that, return on invest, is not a suitable key figure when it comes to trading. Definitely answer no. If you like those percentage numbers, then you have to rethink, like, then you go for the percent return on invest and you divide that one by your percent maximum drawdown. And if that number is bigger than 1, great, you are good. You are on the profitable side, definitely. And if you already have a ratio there of bigger than 2, then you are already extremely good with your trading activities. So really thinking in terms of what gain in percent as return on invest I can achieve with trading is totally wrong, because then we have always to ask what has been the maximum drawdown as well. Nevertheless, because everybody likes those numbers, let's do a quick estimate here. And now we come back to those percent values. And that quick estimate should keep our expectations level not too high. Let's have a look here. Expectation. So think we might be of the opinion that we can gain 10% per month. It sounds not that huge, but you will see it is huge. Following that 10% per month, and I have already added up here all those values in years, would bring an account of 10,000 euro after 10 years to nearly 1,000 million. And now million is in the German language style, so you see the number here written. So it's 100 million. And not 100, 1,000 million in 10 years. Can you think that this is something you can achieve? Definite answer, no. You would even have to wait a couple of years later, or to wait a couple of years more, or you may start already with 100,000. Then your balance sheet is longer than the one of the EZB. Or if I compare those numbers with the budget of the German government, I only need, I think 3 or 4 more years than I have the budget of the German government. Is that reasonable? Answer, no. Nevertheless, there might be months you can get those 10% in a row. But on a long run, like 10 years, no. And even not thinking about that, what I call the luxury problem, how to get my orders into the market if I would order maybe 10,000 lots or euro US dollar long or something like that. That's not the question here. It's simply the question, can we achieve those numbers? And the answer is no. In terms of those numbers, what might be reasonable is in the range of 1 to 2% per month, adding up to about 10 to 20% a year. That is something I think is realistic. To have a different look to that number as well, we can do something which I would not recommend to do every day. We can compare ourselves or our expectations with the real best ones in the world, because there's every year a so-called World Trading Championship, and what you see there is something like you would run against Usain Bolt for 100-meter race, and that is what we are doing now. So let's nevertheless have a look to that World Trading Championship and the current standings right there. And they are here. And what we have now, 9 months are more or less over. There are two championships. One is for future trading, one is for Forex trading. Let's first focus here on the Forex trading, which is more common to what we are doing here. And you see the best 5. The best one is at 100, and already the 5th here is at 21. You can imagine how that row would go further down here if you would see the results of who is ranked at 10, 20, and 100. So let's look to the one at the 5th rank here, 21% after 9 months. And those are the best you can see. So if you compare ourselves with that 1 to 2% per month, which would add above roughly to those 20, 24, 26% a year, hey, that's already impressive. That's a good result. Why do you find even higher numbers on a lot of other contests? Simply because people are gambling. Here they just risk for a single trade, more or less, they do all in, and then maybe they are lucky enough and then they have a gain of 2,000% or something like that. But that's not trading, that's gambling. And that's definitely not what I would recommend. So here, looking to the best you can find, you see that going for an expectation value like I can double my account within 1 year, and I will do it several years in a row, is nothing you can achieve. So nevertheless, it gives us a good comparison to what we personally can expect. And my recommendation here, keep your targets low. That's all. Wow, it's already more than 1 hour here. So in a nutshell, I think, stop loss are important. The given risk is even more important. For your stop loss setting, you might use tools like ATR or Bollinger Bands in order to get rid of the overall market noise. And you have learned that even overtrading, entering too many trades per day, having a too high trading volume per day is a risk additionally. And that high risk reward ratios are not automatically good trades. It's simply a tale about that. And even worse, high risk reward ratios generate from statistical point of view already higher drawdowns. And finally, have always the costs of trades to be taken into account, and keep your expectation levels low. I think then you are in a good way. Avoid gambling in any sense of trading, and that will help to improve your personal trading activities, hopefully. Okay, that's for me right now. Next webinar in 2 weeks will be once again more related directly to trading strategies, but those kind of aspects as today is really important as well, because we love to interpret the chart entering the next trade, and at least we have a set of rules we have to listen, we have to follow, and if we do so, it will help to be better with our trading. That's for now. I hope you enjoyed the webinar once again. See you, or my colleagues will see you in one of those next webinars. Have a nice evening. Bye-bye.